Welcome everyone to the Thursday Elite Zoom training. Today we're gonna go over Mutual of Omaha Index Universal Life Express. Some of the agents have expressed that they have a little hard time figuring out the illustration platform. Like America One, I feel like it's a lot easier. And then F and G, Fidelity One is a lot more advanced. So if you're wanting to do like a max funded IUL focusing on lifetime income, FNG is probably the best one, but also it's quite complicated, right? And when I'm determining which type of IUL a client is going to most suited for, I base it on if the client is looking for affordability and they want to have the benefits of having an IUL, like the long coverage. So if they have a permanent coverage until whenever they die or 120 years old. They also want to have a policy that has cash value accumulation. So all their money that they spent doesn't go away like a term policy. And they want living benefits. But if the client's main focus is to have an affordable plan, like an affordable permanent plan, then the Mutual of Omaha IULE, IUL Express, and Americo Instant Decision IUL is the way to go. Okay. So that's kind of our go-to for that reason, because not all clients can pay five, six, $700 a month. Okay. So we're gonna go to start with the HQ. And on the left side, you're going to click Sales Tools. You're going to click Carriers and Products. Click Carriers, Explore Now. And on here, we're going to click on Mutual of Omaha info. And once you're in here, if you scroll down a little bit, they have some other information about the products, and everything is here. And there is a link called click here to access the WinFlex web application. This is what we need because this will help you generate an illustration for their products. So you click here to access WinFlex. This is where you should be redirected to. Now, if you don't have a WinFlex account yet, then you need to click register for WinFlex and put in all the information. And you have to specifically ask for Mutual of Omaha, United of Omaha slash Mutual of Omaha as the company that you want to do the illustrations with. And it takes about 24 to 48 hours for them to approve you. Okay. So you can't, when you sign up, you don't usually have an access right away to the illustration software. And one of the reasons is because WinFlex is not owned by Mutual of Omaha. WinFlex is a third-party company, and they are an illustration company, illustration software company. So many companies use WinFlex to do the illustration. Companies like Americo, companies like Fidelity and Guarantee, they have their own in-house illustration software. Mutual of Omaha does not yet, so they use the WinFlex. Okay. So
Hey,
once you,
hey, Sean, how did
yeah.
you get the WinFlex from where?
So on the sales tools, you go to carrier and products,
Yeah,
go to carriers, explore now.
carriers and product.
Mhm. Yeah, and then click carriers. You click carriers already?
Oh, explore now carriers. Gotcha.
Yeah, and then you click on Mutual of Omaha info.
Oh, different screen. Got it.
And then when you scroll down all the way to the bottom, there is a click here to access WinFlex web application, or you can just go directly to winflexweb.com, whichever. But I'm just showing you from HQ so that you can just go through HQ. which is our
I got a
booking.
quick question, John.
Yeah,
It says on the first page when you're signing up, it says credentials. What goes in the credentials? Just a state license?
the credentials, let me
Yeah,
just check that for you. There's
it says
nothing.
credentials.
So
Yeah,
you
right
don't
there.
have to put anything. If there's no red
Oh, okay, okay.
star, it's not a mandatory thing. So you can just, you don't
Skip
have
it.
to do anything about that. Okay.
Thanks.
Yeah. And that's also on the application too. Whenever I actually just go ahead and do uh, always if there's a application and there's nothing like a red required, I don't even fill it out, even for clients' life applications or like a contract application, if that makes sense. Okay. Let me just double check here. I think that mine might have been already let's see
It's
if
got
this
a it's got an asterisk for the company name. Is that where we
yeah.
put in Mutual of Omaha?
No, that company name up front right now. Yeah,
Symmetry Financial Group?
you can find symmetry there.
Yeah, okay.
You found it?
Well, it's self-populated symmetry. I just want to make sure that that's not where we put in Mutual of Omaha.
Yeah. Yeah, it's afterwards. You're gonna be putting that in there.
All
So yeah. All right, let me just go ahead and put this here. Okay, so it's at AH3XPOS. So WinFlex, they make you change the password quite a lot. So just make sure you save that. And once you're in the WinFlex dashboard, you see on the carriers, this is the Mutual of Omaha one you have to choose under carriers when you are registering. So it says Mutual of Omaha dash United of Omaha. This is the company that you need to have for in order for you to do an illustration for Mutual of Omaha. Okay. And once you're in, let's just assume that you're already registered and you are in here and you got already approved. So you can even quote Mutual of Omaha or do illustrations for Mutual of Omaha products. And at this point, you're going to click illustrations. And it says start a new case. So you're going to click that. And it says Mutual of Omaha dash United of Omaha. And it'll show you different products. And if you take a look at it, it says Index Universal Life Express. So the word express in the Mutual of Omaha products means that there's no blood work, urine work. It's a simplified underwriting. So we're going to go ahead and click this product and create client. And once you do that, it takes about a few seconds and it's going to generate an illustration platform. And on here, you put the basic information now. So we're going to just put John Smith. And yeah, might as well do 45 male. Let's just leave it at that. And the date of birth. So if you wanted to, you have to put at least one of them. So let's just leave it at 45 for now. This one, standard non-tobacco. And let's just say it is Texas. Solve for. So this is what you have to focus on. Do you see that this was insured? Once you are done with that, then you move to the next one. It says solve for easy solve. Easy solve. So the best way for me to explain that is Mutual of Omaha. Do you remember I told you that the IUL is more geared towards affordability? So IUL is a very flexible plan. Client can overfund it to really max fund the cash value and later use it for like their income, or they can pay kind of like the target where the company recommends for the policy to grow healthy over the period of their lifetime. And but it is more geared towards the affordability. So they're not max funding the policy, they're not minimum funding the policy, they're funding at a pretty good level that it's going to grow healthy and still be affordable. Okay. So that's what easy solve means. So 99% of the time, unless you're going to design it yourself, leave it at easy solve. Does that make sense? And easy solve option, you wanting to solve for premium. Most of the time, clients will tell you, hey, I would like 100 or 200 or $300,000 coverage. Then you need to solve for premium, right? So I input how much face value the client wants, and this is going to calculate how much premium that is. Or you can do it the other way, which is you're going to calculate for what face amount the client can get for the premium that you're going to input. Okay. So this right here, easy solve option, this is what you are wanting to calculate. So if you wanted to just put in $100 a month, then you can do it this way and get the face amount for what the face amount the client can get for $100 a month premium. But if the client is specifically looking for a mortgage coverage or they're looking for a face amount of 200,000, then you're going to click premium because you're solving for premium and you're going to put in here that you client is desiring 200,000. Okay? And disbursement, you don't have to do anything. You leave everything blank, same thing. Index strategies, you don't have to change anything here because it's already defaulted onto the S&P 500 1 year 100 participation account. And if you look at the maximum illustration rate, it's showing 5.95, which is the highest among all of these here. So I'm gonna just leave it at 100% there. Or if the client wants to diversify a little bit, they can. But honestly, why would you change it if, this one is the best performing one? In a fidelity and guarantee, because there are some other indexes that are completely different, that could really be a good diversification. Maybe those ones you do it 50-50 or other allocations. But with a program like this that is simply really focusing on affordability and just like a one type of plan that just fits most people, then you're gonna just leave it at the default 100% on this. Policy options, you don't have to change anything unless the client is going to pay annually or semi-annually or quarterly. BSP is just the bank one that gets drafted directly from the bank. So you can just leave it at BSP. So again, insured and solve for, you have to change it, but disbursement, index strategy, and policy options, you didn't have to change anything, right? Riders, you didn't have to change anything because it's already including the terminal, chronic, and critical illness rider. So living benefits are included in this plan. And then reports, you don't have to change anything here. Agent info, this is where you're going to put your information as an agent. But once you click save, it will save it. So let's just say I go ahead and save it. Then I search for my name. Then you click on this. Then you will automatically generate all my information already in there. Concept, you don't have to do anything. So literally, only thing you need to do if you're just doing a standard illustration is insured. Put the client's information. Solve for, you put in the face amount or the premium that the client desires, and then you just put the agent info. That's it. You don't have to do anything on the disbursement, index strategy, policy options, writers, reports, concepts. And once you're done with that, you click calculate. This takes about 20 seconds or so. It's generating an illustration. There you go. So John Smith, Mutual of Omaha, United of Omaha, Index Universal Life Express, 45 male, 200,000 coverage. Okay, and if you take a look at this, it says illustration with a PDF image, and you click on that. When you click on that, this generates this 20 pages illustration for you. It's actually 38 pages. Wow, quite a lot. And zoom in just a little bit. Just hide this bar. Okay. So the second page, page 2, you see the basic information of the client's info. John Smith, 45, 200,000 in face amount. And some people ask me, why does the death benefit option say 1 to 75? Isn't this supposed to last a lifetime? Yes. So this is number of years. Client is 45 years old right now. So 75 years, what does that make him? 120 years old, right? So this is just showing you how many years the client has the policy for. That's why it says 75. Premium is 172.41. S&P 500, we put 100% on that because that's the best performing one. Riders, chronic illness, critical illness, terminal illness. So clients have this benefit already included at no extra cost. And you can read this at your own time. Some of these are great, like living benefits. It talks about the chronic illness. So if the client cannot perform 2 out of 6 activities of daily living for 90 consecutive days, or if you experience a severe cognitive impairment, like they need to have somebody come to their house, if they have to go to a nursing home or long-term care costs, this can help them out financially. Critical illness, if the client has ALS, kidney failure, life-threatening cancer, major organ failure, heart attack, stroke, major burns, AIDS, dementia, including Alzheimer's, aortic aneurysm surgery. If the client has one of these things, and the living benefits will kick in, and the client can get up to like 80% of the death benefit. Terminal illness, if the client has 12 months or less to live, they can also access that money. So these are included in this plan. And let me just show you something. And after that, there's like not a lot of things that you have to explain to the client. Sometimes when you really over explain, that's when you lose the client because they are confused. Imagine you are a licensed agent and you get confused and you're licensed. These are clients who don't know much about life insurance at all. So if you go into too much detail, you lose them. So keep it simple always. Okay. And now this policy ledger, this is page 28 of 32. This is the actual illustration of this policy. So if you take a look at it, it says non-guaranteed illustrated interest rate of 5.95. This is the historical average of what the index has done and the insurance company Mutual of Omaha has paid out to the clients on average annually. So which is still really good. Savings account, like a typical savings account is like 0.04% interest. If you put in a high yield savings account, maybe you get 3 to 4%. So this is still a attractive interest rate. And the way it works is that as the client pays the monthly premium, portion of that, not all of it, goes to the cash value account. So the best way I can explain it is every time the client deposits $172.41, the money gets deposited, but the 172 does not go into just one account. It goes into two separate accounts. One is the insurance cost bucket. So let's just say 50% of the money goes to the insurance bucket. That means that's for the cost of insurance to give you the living benefits, the death benefit, and to have this policy going for you. That is the half of the premium goes to. The other half of the premium goes to straight to the cash value bucket, and it grows with interest of 5.95% on average. So when the client asks, hey, why is the accumulation value only 1,000 when I'm paying 172 a month times 12? That's almost $2,000 a year. It's because of that reason. Not all money is going to the cash value. If it did, then insurance company will not be in business because they have to be able to operate and offer this benefits to the clients. Now, if a client is specifically asking to max fund it, do you remember IUL is a very flexible plan. So client can pay more to take advantage of the cash value bucket. So if the client wants to put more than 172, they can, and anything above that should go towards the cash value bucket. But if you're doing something like that, I usually recommend Fidelity and Guarantee because of the customization that you can do and the diversification of the investment. So there is more options in case of investment options. Okay. Now, that's why we go with the non-guaranteed because this is the actual average historically over the last 20 plus years, including the 2008 market crash, right? So all these things are included and they're up and down, up and down. So that was the average with the market downsides. Now, this accumulation value is what we call the cash value. But have you noticed on the right side, it says surrender value. So surrender value is if the client wants to cancel the policy and surrender it, in the first 4 years, they're not walking away with any money because few reasons. This IUL, if you remember, it was designed for affordability. This is not a max funded IUL. So not a lot of the money is going straight to the cash value. That's one. Number two, IUL, the way they designed it, they don't want the client to keep canceling after 1 year of getting the policy, right? 1 year they get it, they cancel it next year. They get it again, cancel it. And if they were to return all their money constantly, then they'll go out of business. So what they do is they put a higher surrender value in the first years when you get the policy. That way it discourages the client to cancel the policy. Okay, because if the client keeps canceling the policy, they're not making money because they're not letting the money to compound. As an insurance company, if the client keeps canceling it, they also don't, gain any money as a company. So that's kind of a safety feature in there for the integrity of this product. And as you can see, on the fifth year, they're 1776, and eventually the surrender value keeps going up. And at a certain point, it becomes the same. At 15 years, it's identical. So there's no zero surrender value. And surrender value, as you can see, the percentage becomes lower and lower. So most of the money you can take out, even in the years 10 to 15. All right. So what is the value of client getting a policy like this? First, it's for affordability. So this policy is an affordable IUL. Number two, if you think about it, let's just say client put in $172 a month into a savings account or a checking account that they use with Bank of America, Chase, whatever. Then I told you what the average interest rate is on a regular savings account. It's 0.04%. So if the client pays 172, let's just say this is a homeowner, 45 years old homeowner, and this hypothetical, not a lot of mortgages are 200,000, but just since we quoted 200,000, let's just hypothetically use this example. Client has a $200,000 mortgage. He's 45 years old male. He has a couple of children. He has a wife. And he's putting $172 away in a bank account, into a checking account, savings account. They own a mortgage and client dies unexpectedly or gets cancer or heart attack or stroke. If they didn't have a policy like this and was just putting $172 into a savings account, what would happen to the family? Would the bank pay the mortgage off for the family? No, right? Bank does not pay off the home for the client just for putting in $172 into the checking account or savings account. That means they have no protection in place for the mortgage. So if the client did die unexpectedly in an accident, or if the client had a heart attack or stroke or cancer, then the families now, they have to come up with all that and also have to come up with the mortgage payments. And maybe the client is in a healthy situation, maybe had a stroke, and he can no longer work. Then now when they first qualify for the home, they qualify by having two incomes, the husband and wife. Now the husband cannot work and the wife has to pay for everything. Then now it could be a big financial problem. Instead, What if we have them put the 172 inside of this IUL? So first, God forbid, the worst case scenario, if the income earner, the father passed away, the family will get $200,000 tax-free death benefit that can be used for mortgage to pay off the mortgage, or some of it could be used to bury him, whatever that is, right? And then secondly, it is protecting the family in case he had a heart attack, stroke, or death. That way, if he had a heart attack and he survived, or he had a stroke and he survived, they will be still entitled up to 80% of the death benefit, which in this case, on the 200,000, that's about $160,000 living benefit payout. Do you think that will be helpful to the family who's going through cancer, heart attack, or stroke, or any other critical chronic illness? I would say so. So that is the power of the protection by putting the money in here. But remember, this is not a term policy. This is an IUL. So the client's money is still growing in there and accumulating over time. So I'll just give you an example. At the 20-year mark, client has about $40,565 in there. How much did the client put in? 41,378. So literally in 20 years, after being insured for 20 years, if the client didn't die or had a critical, chronic, or terminal illness, client has access to $40,000 in tax-free cash value. So how incredible is that? They still have access to the money while getting protected. So insurance is really about what if something happens. So in those scenarios, families are protected if something did happen. But we hope for the best. If it didn't happen, then they still have access to that money. And I'll show you a really good a way you can sell more of the higher level products is this. If a client says, like, I want to pay my home off earlier. Some clients say that, right? They don't want to have a mortgage for 30 years. So you ask them, hey, John, I just had a quick question. Have you ever thought about paying off your home early? And guess what they say? They're like, oh, that'll be amazing, but like finances are tight. We just got this home, so I'm not sure. Then I say, the reason why I ask is our really money savvy clients, what they're doing is they're using this mortgage protection plan to not only protect the mortgage, but they can use this money to pay off their home 5 to 7 years early. So now what? Then they're gonna be like, wow, what do you mean? Would you say if you're a homeowner, would that pique your interest? Probably, right? Who doesn't want to pay off your home early? So now I'm saying, hey, you could pay your home off 5 to 7 years early by protecting your family. So then I can show them a term policy that is just no money back and just will do the job and it's much more affordable. And then I'm going to show them an IUL that is affordable, but it's higher than the term, but something that's going to also giving them the savings feature and potentially to pay off the home early. So by the time 25th year comes around, client is 70 and he has $58,420. And let's just say the mortgage left on the loan is 50 grand. Then client can take out the $50,000 from this and pay off the home early. Does that make sense? And then that $50,000 that was taken out of here, it comes out of the death benefit. So the family still has a $150,000 death benefit and living benefits after 70. So now you're solving multiple problems. Do you know that when you retire, a lot of the times your job life insurance does not come with you in retirement? Most of them either stop or you need to pay extra to convert it into a personal private insurance from a group insurance. And that could be 5 times, 10 times. And I'm talking about some clients are paying $500, $1,000 a month. So this is going to give them living benefits, death benefit, protect their mortgage, and potentially pay off their home early. and that's 172. So instead of you saving, most families do put a couple of $100 away into some kind of a rainy day funds, right? So this is not far-fetched. This is really, I think, reasonable. And the reason why I feel like I had an easy time closing the business is because I make it a no-brainer. I make it like, hey, like, do you see what the money savvy clients are doing? Like you said, you put some money aside, put it away on a savings account. Like if something happens to you and you didn't have a policy like this, what would that look like for your family? But if you put that money into just putting into a savings account, if you want to put it into this, you protect your family and you can have more money in here than what you put in over time, and you can potentially pay off your home 5 to 7 years early. So which one do you think is the best option? And I'm going to show them a term, which might be, I'm just going to give you an example. At 45, maybe just the term is like $70 a month, or pay an extra $100 to get something like this, where it has the cash value and the benefits for a lifetime. So I'm just showing it to the client and they make the best decision for themselves. And in case they cannot afford 170 to 41 and they can only afford a term, guess what I do? I say, by the way, John, we can, then why don't we do this? Let's do like a stair step program. What if we first get you a term policy since you can afford $75 a month? And when you're ready, I can convert this policy into this IUL policy for you. So now you are closing the deal because the client wants the IUL but cannot afford it and only can afford a term, then I'm not going to lose that deal. I'm going to show them the term and say, hey, you still get living benefits, but you just bought the home. I know you have a lot of things. So why don't we go ahead and get you protected first? And in the next few years, if you wanted to convert this into a permanent, then I can upgrade this into an IUL for you. And do you know what's the be most beautiful part about this, John? Is that this comes with a guaranteed insurability rider. So even if your health change unexpectedly, they have to guarantee the conversion for you into an IUL. Okay, so, and guess what? You don't stop here. This is where the top producers and a typical agent, the difference is. Then you need to close the deal. I say, John, let's see if you can qualify for this program first. Because if you don't qualify, this doesn't mean anything. Let's go ahead and see if you can qualify for this term policy. How does that sound? Okay. Can I have your driver's license? And then you're closing the deal. So when you go overcome an objection or when you make a statement, then you need to go back to the closing. That's the hardest part about sales is people are afraid to close it all the way. But it's the truth, right? Is there a chance the client can be declined? How many times client has told you that they're perfectly healthy and they get declined? It happens all the time. So it's the truth. If the client cannot qualify, then this is a great plan, but I can't do anything for them with this particular product. Maybe we can do option B, option C with other carriers, but this particular product will not be available for the client. So that's the takeaway. If you were to just say, hey, yeah, you can get this. I know, I can guarantee based on what you're telling me, you can get this, and you're just giving them everything, they're gonna back off. So you gotta take it away because it's the truth. John, we don't even know if you can qualify for this plan. Let's just see if you can even qualify for this plan. But I know one thing, if you have this in place, you'll have so much more peace of mind because we see so many families who keep delaying getting this type of policy. And when something happens already and has a heart attack or has cancer or had an accident, then no longer this policy is available. Okay, so let's go ahead and see if you can qualify for this plan. Do you have your driver's license? Okay. Any questions?
So you just close them with that by saying, how many families don't do it while they can and then end up with these.
Yeah, yeah. And I mean, that was just an example, right? But it's the truth is clients can health can change in just a few seconds. We had clients who had a normal health never goes to the doctor because never felt, weird or sick. And then suddenly has literally a client came in yesterday, actually Nora's client, young guy, had n not much health issues, and then suddenly gallbladder exploded in his body. He turned pale white and he was rushed to the ER. He almost died. Who would think your gallbladder will just explode, right? So guess what happens? Now, a person that was perfectly insurable just yesterday is no longer insurable for the next 6 months at least, because that surgery happened and then insurance company want to make sure there's no complications. So just have that conviction. It's the truth. Client could be in a car accident today, right? Can you guarantee that they're not going to die? No. The only guarantee in life is everybody's going to die at some point. Can you agree with that? Not one
Yes.
will escape death. So people get insurance on everything, but they don't get insurance on something that is guaranteed. That makes no sense. And car, jewelry, home, all these stuff, if you can't pay for it, do those things exist? No. So that's the conviction I just want you to have an agent when you're offering these products, right? You have a question, Michael?
I do. You can actually, would it have to be a Mutual of Omaha term to convert it to an IULE?
Yeah, it will have to be with the same company and it has to be the Term Life Express.
Term
So
Life
Term
Express.
Life Express can be converted into a Mutual of Omaha IULE Express.
And they can do all the, how much insurance they want and
Yeah.
change the payment and all that.
No, not so the max amount they can get is what initially they signed up for the term. So if they got a $200,000 term, then they can only convert up to 200,000.
Well, that's good enough, isn't it?
Yeah, but the monthly premium will be based on the age of conversion. So you can just go to IULE and put the client's current. So if they got the term at 45, but they're converting at 47, then you just go run the IUL Express for 47-year-old, and that's the monthly premium.
And the term was called Term Life Express, correct?
Yeah.
Thank you.
Yeah, you're welcome. Yeah, so Nora, the 15th year for Mutual of Omaha is identical. So the cash value and the surrender value it becomes completely equal. Let me just go ahead and see here. The other question, Cammy, you're asking, can you tell us how you explain to client the difference between guaranteed altered scale and non-guaranteed? Yeah. So the best way I explain it is the guaranteed, this is at a 0%. Because the IUL has a market downside protection, the guaranteed interest rate is 0%, so you never lose money. This we have to contractually show. Mutual of Omaha has to contractually show this legally, but this is assuming the market did negative in the S&P next 20 plus years, back to back, negative, 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 negative. If this happens, the world is coming to an end. Even during the Great Depression, there was never a year more than 3-4 years of negative back-to-back years. So 20 years negative, that means the world is ending. So I don't go by that because that makes no sense because it has never happened in the past, not even more than 3-4 years back to back. This is showing 20 plus years, but contractually we have to show you. Alternate scale, this is showing 3.75. This is showing you a little over half of this, and this is by showing you just another scenario, but at the same time, this is not showing the current historical return. This is the 5.95. This is including the market crashes. This is including the market ups. So if you go to the page, and if you don't really focus on that, Cami, most of the clients will not really asking too much detail unless you point it out. If you go straight to that and focus on that, they usually don't. But if they do, and they're super like analytical type, like an engineer type, then this is the best way we can explain it. So S&P 500, this is the actual historical return from 2005 and 2024. That's the last 20 years, right? So if you take a look at it, that was the annual return. Do you see 2008? There was a negative 38% return. This is the stock market. But if you look at it on our 1 year 100 participation, this is our index. What did happen? It's zero, right? Client didn't lose any money. Why? Because we have a downside protection, right? But when the market does 23%, our client max gets 9.25. That's the ceiling on this particular IUL. Like I said, this is not an IUL for max funding and lifetime income type of product. Then I'll go with F&G. So they have a 9.25. The reason why they can have a feature to protect you from negative 38% is because they also have a ceiling. So it reduces the risk factor. So anytime it goes over 9.25, client will still get 9.25. If the market goes negative, then the client doesn't lose any money. And with this index, we have done 5.95 average interest rate. So when I say this is not the best case scenario, this right here, 5.95 is not the best case scenario. This is the actual historical average of what the index has done and the client has returned, even through the 2008 market crash, which was almost 40% negative. Okay, so does that make sense, Cami?
Yes, it does. Thank you so much.
Yeah, welcome. And Charles, you have a question?
Yes, it's not on this page though. It's a previous page of the living benefit page. So you're using Texas as an illustration, but some states don't have living benefits available. So if I use a different state, will it automatically change, or is it
Yeah.
always going to say the same thing?
No, you gotta, yeah. So do you remember on the illustration software? So this is
Yeah.
what we're doing?
Yes. So if I put in California, it's going to come up
Yeah, yeah, it's in
with
Texas
living
right now.
benefits for California only.
Yeah, exactly. Yeah,
Okay.
California.
I
Okay.
don't want to make a mistake and offer him something I can't give him.
Yeah. Okay. And let me just see.
Sean, I have
Yeah.
another
So
question too.
yeah.
Oh, I can, whatever question is first, you go with that one.
No, go ahead. Yeah.
So,
Uh-huh.
I'm just wondering a little bit with, like, I'm getting a lot of
Mhm.
senior clients or almost senior clients.
Yeah.
And so, as a newer person, looking a lot at the final expenses.
Hmm.
Um, so if you have somebody maybe who's like 57, really good health, they want the living benefits, would this be a good
Oh
like
yeah.
direction to go?
Oh, absolutely. Yeah. Yeah, I mean yeah, okay, that's a great question. Yeah, I know like after a certain age, we teach the agents to go to the final expense most of the time. But one of the reason is because seniors tend to have more health issues. But there are clients who are maybe 50, 60 years old, or I mean, even 70. This product goes up to 75. Okay. So if the client is healthy enough to get this, like they just maybe have a blood pressure, cholesterol, even diabetes, but it is controlled and was diagnosed after 45 years old, then you can go with this first. And that way you have more benefits that you can actually, give the client and it'll be more attractive to the client. So you can even do you know like you do the mortgage payment protection critical period plan? You can use this to even do that. Instead of using a final expense product, you can use this as the product to do the 12 months, 24 months, 36 months coverages and say, hey, even if you didn't die, if you had a heart attack or a stroke, things like that, this can help you pay the mortgage payments for this amount of time, like that. Yeah. So between, let's just say between age 50 and about 70 or so, if the client's health is really good, and I'm not just saying clients saying like, oh, my health is good, but like you've verified with the medications that they're being prescribed and they seem like pretty healthy, then absolutely, I'll show these type of products first, or potentially like a 10-year, 20-year term first, and then the final expense will be the last resort if the health was not as good as they said. Uh, if the client is between 50 and 70, but they have some serious health issues, they maybe had a heart attack 4 years ago, right? Or they have some diabetic complications, they had a stroke or cancer 3, 4 years ago, then I'll go straight to the final expense since the term in IUL is out of the picture.
That makes sense. And if they are really healthy and you verified with medications and they're in this age range, so we'll just say like 60 mid-range,
Yeah.
Do you first try to offer that term because of the costs?
Yeah, what you can do is kind of like what I was saying. Hey, this is a good option and this is the better option. So that you can show them as like this term is great because it protects you and your family, but this will be a term coverage, but this other one you pay a little more, but then you get it for the rest of your life. And one of the things that I share is like one of the biggest regrets for my clients who are seniors or who somebody's retiring is that they didn't get a private insurance outside of work. Because when they retire, they realize, oh, shoot, I'm 65, I'm 67, I'm 70, and my life insurance is not going to come with me. So now they're busy looking for a new one. So you can share this story so that maybe the people you're talking to who are 50s, 60s before the retirement, and you can just share with them that, hey, this is what they regret later, and this is my recommendation to kind of give you a solution. Not
Okay,
just for the mortgage, but the benefits that will continue for the rest of your life, no matter how long you live.
I
So
love
that's
that. And then just to clarify, I know I've asked this before and it's been confirmed, but for some reason it doesn't want to soak in. But when people take out that money from their cash value, even
uh-huh.
though it's a loan,
Hmm.
if they aren't planning on paying that back, then
They don't have to.
there's no interest though, right? Or is there
No,
interest that gets paid
there
back?
is. Yeah, there is,
Okay.
but like I'll just give you an example. So let's just say the interest is 5%, right? But what's the average interest rate you're getting, Cami, on the IUL right now?
The 5.95.
Yeah. So it will be the portion that they borrowed will be a wash, and they might gain actually an interest on the money that they're borrowing because of the feature of gaining interest. So you're not really gonna feel that you're paying an interest because it's gonna pretty much be like a free loan for them. Yeah, right? Because you're paying 5% back, but you're gaining 5.95 on average. So it washes the interest rate. So it's like a free loan, tax-free
Gotcha.
loan.
But if you are withdrawing that money, then you're not earning that 5.95% on it, right?
Correct. So then if you use the feature withdraw, then you don't actually are borrowing from it. So then you don't have to pay any interest back. But the problem is now you actually cashed it out. So you can be subject to taxes now. So the smarter option, like people say buy, borrow, and die. That method of wealth is you buy a life insurance policy and you borrow money from it, and when you die, you leave your family tax-free money. So if you loan it, then it's a pretty much an interest-free loan because of the washing of what the interest you're gaining versus interest you're paying. And when you die, let's just say you borrow $50,000 from it and you never pay back. You had a $200,000 policy, then how much does a family get if the client dies?
So 150, maybe even a little
Yeah,
more, depending on
yeah,
the interest.
exactly. So about 150K. But the client used the money for what they need, but they didn't have to pay it back. So the family still receives the remainder of the value of the
Okay.
debt.
I think this is one of those, the loan part is one of those things that's just going to take a minute to really stick for me. But
Sean,
every time you explain, I get
yeah,
it.
let me explain it like this, that if you have $150 in the bank and you borrow $50, but your $150 still in the bank because you're using that for collateral, and you borrow $50 from the bank, you still have $150 in the bank. When you pay back that $50 you borrowed, you take it out of there, the death benefit only becomes $100. So she's not, what she thinks is that, well, if you borrow the money, they're not going to get interest on it. No, you still get interest on it because it's like a promissory note. You're
It's a
saying,
loan. Yeah,
I'm
it's a
going to pay it
loan.
later.
Yeah. So yeah, that is a good example. Yeah, you're just so your life insurance is just like a collateral, right? Um, and that way you don't pay taxes on the money that you borrow while you're using it, and then you leave your family tax-free money. So that's kind of the infinite banking concept. How do the wealthy families pass down wealth, millions of billions of dollars, without paying taxes? Because they use the life insurance as their own bank and borrow the money from it tax-free. And then when they die, rest of the death benefit goes all to the family and usually into a family trust, and it goes passed down tax-free. So that is the concept behind that.
It sounded like Charles was saying that the money that you borrowed, and I may have misunderstood that, but that because it's like a promissory note, but you're not getting interest on that any longer. So you take that 50 out, there's no
No, no, no.
interest on
So yeah, that I know where, so this is what I think where you're confused. So they give you two options when you're taking out the money. If you were to loan it, loaning is actually borrowing, and there is an interest that you have to pay. But because you're gaining interest still on the entire cash value, you're still gaining interest on that money, and you're paying the 5% back. So it's a wash on that amount.
that. Okay.
Whereas if you do a withdrawal is completely different. Withdrawal is actually you took out $50,000, so there's no more interest gaining on that $50,000, right? But you took it out. But if you do it that way, then you can be taxed on that money because you actually took it out as an income. Does that make sense?
Yes. Okay. I was getting
Yeah.
kind of confused with those
Yeah.
two options.
Hmm.
And sorry, one more question. If, say,
Yeah.
there is a 60-year-old healthy man, you're leaning towards, you're going to give him an IUL option. Would
Okay.
you go with one of these more simple, affordable products for a 60-year-old versus a younger 40-year-old, 30-year-old F&G type idea?
Oh, absolutely. For older people, I usually never use F&G because I mean, you could be thousands of dollars a month and you
Okay.
could turn them off. And so I would specifically, if it's a senior and they just want to have a lifetime coverage so it doesn't run out, if they want living benefits, if they want affordable premium, the Mutual of Omaha IUL, the America IUL will be a great option for them.
Awesome. Thank you so much.
Yeah, yeah, you're welcome. Yeah, so this is a great product. So it will make sense for clients who are looking for that longevity, right? And clients who are looking for living benefits, but maybe they're still healthy enough that they don't have to get a final expense. So this could also be a really good clients for that middle group where their age is 50, 60, 70, but they're still healthy enough to get it. This is a better deal. Okay. All right. All right, guys. I know it's a longer than usual, but I'm glad that we are able to clarify some of the things. This will be recorded. This is recorded, so we'll be posting this on the Kim Agency and Engage Line. Engage Line, we're gonna have it up, so you're gonna be able to watch this, at a later time. Okay. All right, guys. Thanks for joining, and I'll see you next time. Take care.